We are covering currency risk and political risk, two critical concepts for the Series 65 exam, especially when dealing with international investments like American Depositary Receipts, or ADRs. A common exam trap is to assume that because an ADR trades in US dollars on a US exchange, it has no currency risk. This is incorrect. The value of an ADR is directly linked to the value of the underlying foreign shares and the exchange rate between that country's currency and the US dollar. Let's break down currency risk, also known as exchange rate risk, with a clear exam-style example. Imagine a US investor buys an ADR for a German car company. The company is profitable and its stock price rises 10% in euros. However, during the same period, the US dollar strengthens significantly against the euro. When the investor's returns are converted from euros back into dollars, the gain is reduced or even wiped out. The exam will test this by asking what happens to a U.S. investor's returns on foreign assets if the U.S. dollar appreciates or strengthens. A stronger dollar is unfavorable for a U.S. investor holding international securities. Conversely, a weakening U.S. dollar would have enhanced the investor's returns. To remember this, use the mental shortcut: strong dollar shrinks. When the U.S. dollar gets stronger, the value of your foreign returns shrinks when converted back. This is a crucial concept because you're essentially making two bets, one on the foreign company's performance and one on the currency exchange rate. Next, we have political risk, which is the danger that actions by a foreign government will negatively impact an investment. The Series 65 exam often breaks this down into two specific subtypes. The first is sovereign risk, which is the most extreme form of political risk. This is the risk that a foreign government will default on its debt obligations or refuse to pay back its bonds. Think of a government collapsing or choosing to repudiate its debt. This would be catastrophic for investors holding that country's government bonds. The second subtype is regulatory risk. This is more common and involves a foreign government changing its laws or regulations in a way that harms the investment. For example, a country could nationalize an industry, seize corporate assets, or implement new tax laws that reduce the company's profitability, thereby hurting the value of your investment in that company. So, if you're holding these foreign investments and are concerned about currency fluctuations, how can you protect your portfolio? The exam expects you to know about hedging. The primary strategy to hedge against a decline in a foreign currency's value is to use options. For instance, if a portfolio manager holds a large number of Japanese stocks and fears the Japanese yen will weaken against the dollar, they would buy puts on the yen. If the yen does weaken, the gains from the put options would help offset the losses experienced on the stock portfolio when converting the value back to US dollars. The exam focuses on the conceptual understanding that buying a put on a foreign currency is the appropriate way to protect an existing investment denominated in that currency from a decline in its value.